Joining me now, Yardeni Research President Ed Yardeni. Ed, you're a movie buff. I know you love High Noon. Just a real quick trivia. What was the character's name?
That I don't know. I know Gary Cooper.
Yeah, Will Kane. Can you believe it? Although spelled differently than our Will Kane. Right. So listen, obviously your gig is getting harder and harder, but doesn't in many ways that make it even more important?
Well, I think so. I tend to get the most interest in my work when things are either bad or just volatile, making it very hard for people to understand what's going on. And so I think there's still a place for strategists to try to put things into perspective. I think I do a better job than maybe others do, but then again, there's others that probably have the same opinion.
Yeah, well, your record speaks for itself, and you're being very modest. Let's talk about the adjustments that you've made, because everyone in the last 24, 48 hours has made some adjustments. So you're old, going into the weekend, you were at 6,000, earnings up to $300, the 20 PE, and you looked at the GDP, maybe 0.5%, 1.5%. This is compelling, right? So now you're at 6,500 with the same earnings and higher PE. What drives a higher PE now?
Well, I think it's got to be the Magnificent Seven, right? I mean, those stocks may very well be going back to accounting for 30% of the S&P 500 market capitalization, and their forward PE is extremely high. It had a big correction, but it could easily rebound here as people conclude that these are amazing stocks that through thick and thin have survived a lot of volatility and continue to generate great revenues and great earnings. You
know, ironically, that's been one of the areas where a lot of strategists have differed than you, right? All of last year, almost every other week, some major firm was downplaying or downgrading the Mag 7. You more or less stayed the course. And your latest note, it was pretty interesting. You said, call us delusional optimists. You know, of course, we're talking here about the economy, potential recession. Yeah. You're not there yet. You never really got there. So how much risk is there now? Everyone's kind of coming down on recession talk. What are you saying?
Well, it is a little unnerving that all of a sudden we got nothing to worry about, or a lot less to worry about. There's even a breakout of ceasefire talks everywhere. We don't actually have the ceasefires, but at least people are talking about moving in that direction on a lot of geopolitical hotspots. And, you know, not too long ago when people asked me what's there to worry about, so the only thing I can really come up with is geopolitics and tariffs, and I misjudged just how negative the tariff talk would be. But on the other hand, I'm happy to say that on April 7th, we did write a piece in which we said, you know, we had such the Liberation Day was followed by a couple of annihilation days.
Right.
This is going to put a lot of pressure on the president to postpone the tariffs. And when he does, the market will have a V-shaped recovery. We wrote that on April 7th, and on April 8th, we made the correction low. And on April 9th, straight up almost 10% and never looked back.
Let me ask you along that same line of thinking, the dollar, right? Because it was the treasury yields going up, stock market collapsing, the dollar collapsing. Great chart here. So this is the DXY. Most folks were referring to this move here. And you were saying maybe the better one is like the Fed's dollar index if we're going to really make that assessment.
Well, the DXY is a very misleading indicator. Everybody thinks it's a trade-weighted dollar. It's not a trade-weighted dollar at all. Actually, it's fixed weights, and the euro has a weight of 57%. So in effect, that DXY is basically you're looking at the euro versus the dollar, which is kind of meaningless. Just take a look at the euro, and it's just developed currency, so it's got the yen in there as well. But the trade-weighted dollar, which the Fed puts out weekly, every week they put out daily data for the previous week. And what you see there is you see that while the DXY has been kind of going sideways, and more recently this year it's been going down, leading to all this anxiety. Oh my God, the U.S. is not so exceptional after all. If you look at the trade-weighted dollar, it just continues to be on an upward trend. That's largely because the dollar remains very strong against emerging market economies, and we do trade more and more with them. So I think this fear that the dollar is going to collapse is just nonsense.
Hey, I got less than 30 seconds, but I want to get back to your V-shaped call. This is the call you made here. Obviously, we've made the V-shape, but we've come a long way in a short period of time. Do you think we have to pull back? Are you in the camp that says maybe we retest that low?
No way. No, I should never say no way. There's always a possible way, but that wasn't I'll go with my initial instinct, no way, but with a hedge clause that, obviously things could go wrong. But no, I don't think so. I think that, we got there on a fear that tariffs would cause a recession. And I think everybody's come to agree that that's much less likely. So what else is going to cause a recession? The Fed isn't going to be tightening.
Right.
Geopolitical crises seem to be coming down. The price of oil has come down. So no, I think if anything, the surprise is that I'm going to seriously regret that I lowered my year-end target from 7,000 to 6,400 to 6,000 earlier this year, and say and ask everybody to forgive me, or at least to forget what I said. And remember my 7,000 call.
Don't worry, they won't take you down from the Mount Rushmore of Wall Street strategists. You're still up there, my man. Thank you so much, Ed. Always appreciate it. You got it.